Good afternoon, everyone. This is Ben Ryan of Hedgeye's macro team, and welcome to our second installment of Fed Day Live. Lots of exciting stuff going on. The statement just came out, so we can just go ahead and turn it over to Keith. What are you seeing?
Thanks, Ben. Interesting, not entirely surprising. I think if the headline here would be that the Fed really didn't change a whole heck of a lot, if anything at all. I'll just go through what that means line by line, first going through both growth and inflation one by one. On growth, they like to blame everything that they don't like to see from a headline perspective on things like the weather. They called it transitory, etc. So that's interesting. That's what they said. What we would say about that is on a year-over-year basis, GDP growth was actually 3%. It was quite good. And we would argue, as they argue if you look at the Fed's statement tracker on the Wall Street Journal site, you could see that where they show you the words that were removed versus the words that were added. Most of the benefits in what the Fed saw in the economy were largely due to down oil prices. So again, that's why year-over-year GDP growth was quite good. The Fed, unfortunately, doesn't look at year-over-year growth in terms of how they're communicating the current message. So again, on growth, excuse-making, calling it transitory, weather, etc. On inflation, again, they have had the view that oil going down is transitory, which is, again, that's what they say when something happens that they didn't predict to happen. So again, within that statement, they also have an explicit statement that they expect, and I'll quote, that they are reasonably confident that inflation will move back to their 2% target. Now, notwithstanding that that's mathematically impossible at this juncture anytime soon on the duration that you're most likely thinking about, because again, we're thinking about the next 3 to 6 months and risk managing what the Fed does, where the dots go, etc. The reality is that the Fed has always thought that they're going to hit their inflation targets, and they just haven't hit their growth and or inflation targets. So that's another interesting point. So on growth and inflation, those are the two main headlines, which are more a reiteration of, I think, what consensus was expecting, and certainly what we were expecting. Now on timing, this is probably the most important point. Away from being, quote unquote, reasonably confident about their inflation forecast, which we're reasonably confident that their forecast will be wrong, they're saying that they're looking for further improvement in the labor market when it comes to timing. So this is the most important point, and I've thought this the entire time. The only thing that really matters at this point is getting the rate of change in jobs right. So that's why bond yields went down and the dollar started going down after the most recent jobs report. It was really the worst jobs report in the last 7 months in rate of change terms. So again, what is the market going to look like going into May the 8th? That's the next jobs report date. That's the month of April employment date. Now again, if you're handicapping it month to month, you'd say it was so bad that it can only be better versus the prior. Or you just say, look, I'm going to be data dependent, because if that number is bad, or the month after that is bad, you're going to have expectations continue to push the dots out on further and lower for longer in terms of rate hikes, pushing them out further. So again, the Fed is actually data dependent on the most lagging economic indicator that you can find, which is, of course, jobs on non-farm payrolls. So again, we've proved this. We can show you a host of slides in our labor cycle work. We can also show you this in our most recent late cycle data. So again, late cycle, we're just using more than just the labor cycle to show you where you are in the cycle. So again, what the Fed is focusing you on is the jobs market. So again, that's basically an unpredictable number. We've tried to model it, our healthcare guys, our macro guys, everyone. It's an unpredictable number. So what I think this is going to do is it's going to create more volatility in the market, because it forces you to guess, or at least forces me to guess. Now, my confirmation bias would be in that I have no edge on that number, therefore I actually have to guess. So I have to let the market trade back and forth within a range, and I'm talking about foreign currency markets, bond markets, and stock markets. And what those markets are doing specifically is the ranges in our vernacular or our process, the ranges are widening. So that's why I'm saying that I'm expecting a more volatile market, not only because the Fed just pointed to a random data point, which will drive volatility, but that's just what the math is telling me. And again, I'm building those models on a historical basis when I'm calculating volatility, again, dynamically adjusting for the variance or the risk, the variance on the risk range. So again, we could talk about the calculation on that, but that's what it is. Finally, I'd say this, and I want to take some questions. On parsing the data, and I alluded to, and it is quite a good tool. They got it up right away. It's called the Fed Statement Tracker. They have that up, and again, it shows the immediate release of the Fed, what they said, And what changed? So again, what changed in the immediate term release is almost an admission that the Fed is starting to understand the benefits to Americans of a strong dollar, okay? Everything that's positive in this Fed statement tracker versus the prior statement, side-by-side analysis, is the Fed is starting to understand what we've been saying all along, and history told us this, we didn't come up with it on our own, whether you look at 1983 to 1989 or 1993 to 1999, Reagan and Clinton are revered for these very reasons. Again, the strong dollar benefits to American consumption are time-stamped. They've been time-stamped in the first quarter, by the way. All the benefits in consumption growth, which they also trumpet because the numbers were good on a real consumption basis, are directly the beneficiary of a strong dollar. So this really, to me, is a very constructive thing because no matter what the jobs market is doing, you're actually starting to see at least something that Bernanke would have never shown us. Bernanke never talked about the dollar, by the way, at all. Like, he would have had to take on the reason for that is, of course, transparency and accountability. He would have had to be responsible, like you are now, Mr. Bernanke. You're employed by a couple firms. It's okay. You have to be transparent and accountable on what you did. So what he did was he devalued the dollar to a 40-year low. I mean, he wasn't talking about the net benefit of that to the American consumer from a purchasing power basis. He wasn't talking about the drop-down effects of that or the correlated effects of inequality on that. Now you have a Fed that's starting to understand this a little bit. I like that. Go, Janet, you go. All right, that's all I have to say.
Thanks,
Let's take some questions.
Yeah, we have a good queue here. First one, this is a very broad question. What's the biggest risk you see to the U.S. economy?
To the U.S. economy, just gravity. It's a cycle. So again, it's a cycle, stupid. And don't be stupid and look at Q over Q SAR when you think about the trajectory of the U.S. economy. U.S. economy is best measured on a year-over-year basis. And you don't have to worry about the weather and the transitory nature. You build the model like we do on a 2 and a 3 year basis so you can smooth out any kind of a shock and you can look at the economy in terms of its rate of change. The biggest risk is the cycle. We're 71 months in, going in on 72 months in to what we would call an economic expansion. The risk is the cycle. It's the cycle, stupid. Unless you think a central planner can eliminate the cycle's going to happen, and the cycle from here, which is, again, the best consumption growth numbers we've seen on a real consumption basis. Don't let the journal or whoever tell you otherwise on a 0.2% GDP headline number. It imputed to a 3% year-over-year GDP number because U.S. real consumption growth is at a 10-year high. And again, I'm not making this up. It may sound odd because you're so cued in to what mainstream has to write about these days, but that's the point. From here, it's going to get tougher. And it's going to slow like any other cycle does, because that's what cycles do when they have to comp against the most recent compares that are embedded in the cycle.
Okay. In your work, you show that wage inflation peaks concurrently with the economic cycle. That in conjunction with your bullish bias on home price appreciation should augur well for the Fed's hawkish forecast. Would you agree or disagree?
On wage inflation, would I agree that is peaking?
Yeah.
Or is that what the question is?
Well, you show that wage inflation peaks concurrently with the economic cycle.
Yeah, I mean, what we show is that most labor indicators are late cycle. Something like non-farm payroll, you can see it in the data. Hopefully the team can throw these charts up. It's in theme number 1 of the current macro deck, where we show a gigantic amount of cycle data. Non-farm payrolls peak after the cycle has peaked, and things like wage growth peak at the end of the cycle. They're not as late cycle as something like non-farm payrolls, but they're late cycle. They peak at the end of the cycle. When something like an inflation-oriented subsector of the economy starts to see less inflation, guess what? The high wage earners in that subsector get paid less. So think about people that are working in the state of Texas, North Dakota, South Dakota. Go around to the 8 oil states or those states that are highly impacted by the oil and gas market. So again, Wage growth, while, relatively anemic, it was still good in rate of change terms. Absolutists would say that it just wasn't what it used to be. It could have been 4 to 5%. Who cares if it's not 4 to 5%? It had its cycle. That cycle peaks at the end of the cycle. That's what you're going to get. So you started to see, and that was one of the bigger problems in the most recent jobs report, was that wage growth just was nowhere to be found. I mean, it was to be found where it was centrally planned and mandated, which is called centrally planned minimum wage hikes. I mean, that's one way to get what you didn't get when you were saying you were going to get it, is to just mandate it. Some people would call those price controls, but I wouldn't go much further than what those cycle charts look like. Again, we could send those to you. They're very clear.
Okay, let's just say this is a political exercise, and the Fed hikes in September. At what quantitative level on the 10-year yield does the Treasury bond market look like a short to you?
240. The problem here is expectations. Okay, it's not just a problem; it just is what it is. People for 2 years have been saying that interest rates, after we said interest rates would go up in 2013. At that point, after they'd gone up, everyone said, oh, they're going to go up. And then they went down. And then they went down and down and down. And then in January, they almost retested their all-time lows on the 10-year bond yield. So you sucked a lot of people into that trade. Then you kind of whipped around. On the good jobs reports, bond yields went up. On the bad jobs reports, they went down. That's why I've said, keep it simple, stupid. If you have to focus on getting one thing right, it's the rate of change month over month in the jobs report. Because again, the bond market is absolutely keying off that. So if we get into a place, let's say for argument's sake, that the May 8th jobs report, let's say that you have it in your back pocket, and if you have it, please don't call me or email me because it's illegal. But again, if you knew that the May 8th jobs report was just a barn burner, awesome, just rainbows and puppy dogs, then you would put the intermediate term level of resistance in play on the 10-year bond yield, which was again would correlate to a pulling forward as opposed to a pushing out of the dots. That's how I think about that. So instead of going from, as we have, the dots have gone from June to September to December, when bond yields got down to 1.85% on the 10-year, back to September, and they're going to sit there and they're going to oscillate like a ball on a golf green. And there's a lot of wind and a lot of volatility, and you're going to have to deal with it, whether you like it or not.
All right, sticking with the labor market, given that you don't anticipate wage growth to accelerate from here, does that imply you're forecasting a recession soon?
No, I'm not forecasting a recession. I mean, I don't forecast something that's not in our model or in our numbers. A recession would qualify as some kind of a negative growth rate, not a headline 0.2% number that people are going to try to sell books on. I mean, that's not what we're looking at. I mean, we will not forecast an inflation until the model implies, or we will not forecast a recession. Apologies for the maybe the Freudian slip there, but we would not forecast that until the forecast tells us to forecast that. Don't forget that how we model things is on a predictive tracking algorithm basis. So again, as the data changes, we change. And again, we use a Bayesian inference process within that. So again, constantly getting new information. We're happy to change our mind as the information changes. And currently, we're not predicting a recession. One way to do it is to get a recession would be to shock the market into a slowdown with multiple rate hikes, like something like you had in the last rate hike cycle. I think you had 25 basis point hikes for 17 meetings in a row. I'm pretty sure the dude in Texas doesn't want that. The guy in Alberta, sorry, big Alberta, Darrell Jones, you don't want to see that either. That would be a huge issue, and that could be the recession. Again, perversely, the Fed can perpetuate its own recession.
No, on the investing side, energy-related investment was cut in half.
Yeah.
Yeah, obviously.
I mean, it's a cyclical factor, okay? If the Fed is going to try to cyclically smooth the economy, and they provide a shock, interest rate shock, while the economy is slowing in the second and the third quarter, the timing's going to be bad, and that's where you raise the risk of having something that might feel like a recession. I would argue that a lot of people in this business will feel like it's a recession if the S&P 500 goes down more than 5%. That's just an argument. We could have an argument about that. Imagine we went down 10, 15, or 20%. That would just be horror.
So this question is alluding to our macro deck, and I believe we can pull that up. Slide 81 of your latest macro themes deck suggests the dollar almost always sells off basically every time the Fed starts to hike. What is the catalyst for higher U.S. dollar index from here? QE2 in Europe, can they even do that given that they just started in January?
The catalyst for the dollar to go up could be multifold, multi-duration, multi-factor. It could be the Europeans continuing on the path that they've been on. Don't forget that Draghi, feels like a worldwide rock star because of what he's done to the euro. I think he's committed to it. I could be wrong on that. You also have the Japanese who are fully committed to creating some level of inflation that they haven't yet been able to create. And then you have the rest of the world. I mean, Thailand this morning woke up and said, yeah, we should cut rates. Everybody should cut rates. That's what they actually think. When they see economic adversity, As opposed to a good hockey team, they would not look within. They look outward with an excuse to make and some action or some kind of token action where a politician, that's what they think they should do. So I think that we're at the end of potentially that. And that's just, again, a basic thought, and that's why I wanted you to take some time to look at the side-by-side in the Fed statement here and parse it, and look at Janet Yellen's statements versus what a Bernanke statement would have looked like. Bernanke absolutely and undeniably would not support a strong dollar policy because he fundamentally was on his path and did not believe that the strong dollar was indeed the path to real economic growth. So again, that would also be, if we get ourselves outside of the slide 81 in our own Tiffany box and say, let's just think lucidly, and let's just say, imagine into the next presidential cycle that supporting a strong dollar becomes just a phase transition at the Federal Reserve. That could easily be something that could go on and on and on for long periods of time, as it has in many long dollar cycles. I mean, it would be fantastic to see. I currently don't see it, but I saw a hint of that, just a hint, in the side-by-side in parsing the Fed statement today.
Okay, question on the 10-year Treasury yield. What's the trade line for the 10-year Treasury yield, and if it breaks out above that?
The trend line?
The question is the trade line, so I think we're going to have to go through kind of a trend process plan. But what's the trade line for the 10-year Treasury yield? And if it breaks out above that, do you just book them and get out of the way of a test of 240? So I think that assumes, would you capitulate on that 240 line of support? A move like that would represent an absolute change in bond price terms. Yeah, I mean, I'm not into the business of capitulating. I mean, that's not kind of how I roll. But if you look at, immediate term trade resistance for the 10-year bond yield is 2.03%. You're testing people's anxieties on that right now today. I can assure you. And the immediate term range, by the way, just widened out to 184 to 203. And somebody said, well, we're above 203. Exactly. It's a multi-standard deviation move. It's actually a very big move in probability speak. And that's what you got. So do you buy or sell the high end of the range? You know how I think about that. Unless something dramatically changed today, which it did not, and I'd still say that the odds are 50-50 on the May 8th report, because a jobs report, so I don't know what that number is. That's where the next big move happens. So the most likely thing that happens in the immediate term is that the 10-year bond yield hangs out where it is here, and then in the next 3 or 4 trading days, it's at 195, and you get a chance to get out of the way. That's how I'm going to deal with it. I mean, that's just me. The intermediate term trend resistance line of 239, I think that would absolutely be in play if the jobs report's good. That's what the Fed just told you. You don't have to you don't have to argue about that. That's what they just said. So again, that's what makes this difficult. Are we really, as investors now and asset allocators, tasked with that very task of guessing? I think the answer is absolutely yes. And again, if you're only guessing on a long-term basis, again, take yourself outside of the question on the levels and say, you're really anchoring on May 8th, Keith. What about, I don't know what the date of the May report, which will be in June, will be, but what happens if the June report is really bad? The whole point of doing the long cycle data on employment is that the probability is rising that the rate of change on not a 1 week or a 2 week duration, I'm talking about a multi-month, multi-quarter duration, that labor starts to get less good at an accelerating rate. And if that's the case, then the Fed will go right back to where they went on the most recent bad jobs report and drop the 10-year back to where it was, which is somewhere in between 1.6 and 1.8%. So you got a lot of wood to chop here. I wouldn't think in a box. I absolutely would not. I'd wake up every day and I'd be about as humble as a human being could be and embrace the risk of the range and all that comes with it. Okay, well then who wins the currency wars over the intermediate to long term, the ECB's Euro or Fed's USD? Well, it depends on how you define win. I mean, I think a politician would say, if I devalue the currency and the stock market goes up and I look good politically, I win. Mm-hmm. The poor bastard who just lost all of his purchasing power and is on the wrong side of the inequality curve, I'm pretty sure he didn't win, or she. So the question, I think you'd have to tell me who's winning. Yeah. I think generally speaking. How about just looking at the movement of currencies? Like if this global deflation plays out over the long term, what is the relative policy of the ECB and BOJ going to outweigh what the Fed does?
Across centuries of time, the country that wins is the country with the strongest currency and the country that holds the most gold. Biggest military, throw that in there too. When you get on the path of all that needing to be centrally planned, and you have to devalue, and you have to go on and on and on and make stuff up and make up calculations and tell stories to yourself, you're losing. So I think the ultimate winner, if we taught the world how to do this, because Japan's been trying it forever, and Krugman would argue they just didn't do enough, now they're going to do everything that they possibly can. Europe's fully loaded, fully loaded to the gills with the same expectation. Maybe there's a chance, and not that you care about my own longer term perspective, but there's a chance that America learns from all this, and they're the ones who end up with the stronger currency. Wherever ends up with the stronger currency is going to win.
Do you think it's
economically?
Do you think it's possible for a country to print their way to a deleveraging without completely destroying their currency?
Not when it's aggressive, not when it's quantitative easing. That is as aggressive as history has ever seen it. I mean, you can go for hyperinflation, mid-1920s style Weimar Republic. We haven't seen that, thank God, yet. I'm not saying that I'd rule it out that the Japanese go there. Again, anything can happen.
Okay, what three sectors of the S&P look best from a trend perspective?
From a trend perspective, I'd say healthcare, consumer staple. The Quad 4 setup looks the best, unfortunately, because Quad 4 isn't exactly a growth environment. So I'd say healthcare, consumer staples, REITs. They're at the low end of their range right now because people are now all going to be freaked out that rates are going to go straight up to the moon. So I get it, but I think the question is from a longer term perspective, which I think the answer there lies, and again, this is what I believe, so I could be completely wrong on this, but I believe that the labor cycle data is indeed cyclical. So again, I think in the next 3 to 6 months, all those labor cycle charts, wage inflations will look like inflation started to. For example, rate of change goes delta negative and then it starts to accelerate on the downside. Fed freaks out. Ultimately, rates just go back to where they were 2 weeks ago or 3 months ago. And that's what I believe. That's the biggest risk to my belief. Everything else above and beyond that is a pretty good argument about what the next data point is, which, unless you have insider information, it's pretty hard to debate that until you get the next data point.
Okay. Question on asset allocation here, I guess, it's kind of a short-term trend. What do you make of the big divergence in year-over-year growth in Q1, the way we look at it, the way Hedgeye looks at it, versus quarter-over-quarter SAR from an asset allocation and tactical perspective? Anything to do short-term versus what you see as tough comps for Q2?
I think if you look at how we looked at it, and again, the reason why we do that is to make you money, or try to make you not lose money. So in other words, if you identify what quadrant you're in, and in the first quarter we thought, our model said you're in the first quadrant, and that you'd have 3% year-over-year U.S. real GDP growth. You had 3% year-over-year real U.S. GDP growth. What sectors did we tell you to buy? Housing, consumer discretionary, healthcare, even said buy the Russell 2000 because it's a growth environment. So the model nailed the asset allocation call on that. That's a very immediate term call because we went into the first quadrant. There's a big year-over-year comp gain there versus the prior year's comp, which was easy. If you look forward and you say we're going to be meandering between the third and the fourth quadrant, you wouldn't own what you did in the first quarter. You'd sell a lot of that growth stuff, and you'd actually start to kind of risk manage within the range of the inflation expectation, because that's going to bob and weave, and so are the growth expectations. Again, the growth or the rate sensitive sectors are going to be very, very much prone, I think, to whip or volatility during these kind of moves around jobs reports. I think that's, you got a lot going on there. You got the dollar move versus what quad you're in, and then you got the rates move, which are moving the rate sensitive sectors. So this is not going to be easy. It's not for the faint of heart. And my move, if I was running money, again, what I'd do is I'd take everything that we made in the first quarter and I'd sell in May and go away. I'd just take the whole thing down. From a long-term bond investor's perspective, if I just want to close my eyes and wake up at the end of the year and we go back to 1 something on the 10-year, which I don't generally close my eyes and come back in 6 months, or most of you would fire me. I'd be okay with that, but in the meantime, I'd probably cut the positions in half or by 2/3. I mean, why wouldn't I? It's been a great run to be long bonds, and if you are nervous, as I am, about not knowing what the next jobs report is, why wouldn't you sell some of that rate-sensitive stuff on the most recent bounce? Don't forget and don't disrespect that the U.S. stock market just hit its all-time high Monday, okay? That's not a very long time ago, but it is a long time to have achieved the all-time high. So in the broader context of everything that I'm saying, there's a lot of market risk. Because why would you bang your head against the wall from here if you miss being long energy? Or why would you bang your head against the wall and say, I got to sell utilities or REITs down here, or I'm going to buy consumer at the all-time highs, when you could just sell a bunch of stuff, raise some cash, and sleep a little better? I mean, I think I need it. My hair's definitely going grayer at an accelerating rate, which I don't entirely need.
Okay, process question. How do you think about weighing frequentist factors like your economic cycle work or empirical studies versus Bayesian factors like quant signals or the latest reported data point? Do you agree that they both have value, and how do you think about weighting these factors?
Yeah, of course they have value. I mean, frequentist, just to review, a frequentist probability theory would be based on this happened X percentage of times, this happened, therefore it's going to happen that many times next time. So that's kind of one of the, there's a lot of value in that because, of course, disowning frequentist theory would be disowning history, which is preposterous. Whereas Bayesian inference is much more, yes, I understand history, I've contextualized it, I understand what happened in these different scenarios, but I'm not one of these golfers who walks onto that course and when the wind just changed by 30 miles an hour that I'm going to hit the same club. A Bayesian is open and honest and humble with what they just learned that day. And then the next day you learn again, and then the day you unlearn and relearn. That's the difference. I say you do both, and guess what? There's a lot more work in understanding the history of it all than there is opening your mind, which is more of a psychological exercise, to using the Bayesian process as an overlay.
Okay. Last question. Which two of your top 5 long and top 5 short ideas do you have the most conviction in right here now? I
don't have a lot of conviction in anything. I mean, I want to go sit down and have a glass of water.
Yeah, you're a little handicapped.
Yeah, I'm a little handicapped because I'm sitting here thinking, again, we made some big calls this year. We made the call to be long bonds into the lows of January. We made the call to stay with the consumption call in the entire first quarter. We made the call to be long housing. Now, everything that the Fed just laid out to me takes all those good ideas, particularly housing, those are the one that I'm least confident in. If that jobs report's better, housing stocks are going down no matter what the housing market does. How could you be confident in that? Unless, of course, you have a mandate to be a longer-term investor, which thank God many of you do, but unfortunately I don't. I don't get to be long-term and just dismiss every mistake I make as just it being eventually going to be right. I mean, I have to deal with this in between. So I'm actually highly unconfident. From right here until May 8th, it's going to be a highly unconfident position for me to rattle off, my best ideas. On the stock front, with our analysts, obviously we have a very vibrant list of names that we like and don't like, irrespective of the macro environment. So again, that's an entirely different discussion.
All right. Thanks, Keith. Lots of good color today. Putting you on the hot seat, that's for sure. Well, thanks everyone for tuning in, and I hope to catch you back here in future shows. Good luck out there.